So Griffon Corporation just dropped their Q3 earnings and wow, the market did not like what it saw. But here's the thing, that big scary number everyone's talking about, it might not be the whole story, not even close. Let's dig in and figure out what's really going on under the hood. And there it is, a nearly 14% drop in a single day. That's the market's verdict right there, swift and brutal. Ouch. Okay, so how do we make sense of a drop that big? Here's our game plan. We're going to look at the headline numbers, then dive into this tale of two segments that's at the heart of the story. We'll unpack the market's reaction, see what management is doing about it, and then, of course, we'll give you our take on what to watch for.
All right, let's get right into it. Section 1, the headline numbers. And yeah, on the surface, things look pretty messy.
Okay, take a look at this table. You see that big GAAP EPS loss of negative $2.65? That's the number that probably scared a lot of people. But, and this is a huge but, look at the adjusted earnings. $1.50, right on the money with what analysts were expecting. So what was the real problem? It was the top line. Revenue came in at about $613 million, a good bit shy of the $650 million the street was looking for. That's a 5.6% miss, and in this market, that gets noticed.
So where did that giant gap loss even come from? Well, it all boils down to this one thing, a massive, one-time, non-cash write-down on their Hunter fan brand. Basically, they're saying the brand isn't worth as much as they thought, thanks to weak demand and some tariff issues. The key words here are non-cash. Management tried to calm everyone down, calling it more optical than operational. In other words, it looks bad on paper, but it doesn't affect our cash flow.
All right, so that's the messy surface. But the real story, the one you need to understand, is that Griffon is basically two completely different companies living under one roof right now. It's a classic tale of two segments. And this slide just lays it out perfectly. You've got Home and Building Products, or HPP. This is the engine of the company. Revenue's up, earnings are up. They even raised margin guidance to over 31%. This part of the business is absolutely crushing it, thanks to a hot repair and remodel market. But then you have Consumer and Professional Products, CPP. This is the anchor. Revenue is down a whopping 16%. They're getting slammed by weak demand, tariff problems, and it's all dragging their margins down. This is the core conflict right here.
And you don't even have to take my word for it. Just listen to the CEO, Ron Kramer. He's practically glowing about HBP, talking about how profitability exceeded our expectations with fantastic margins. He's pointing to pricing power and a strong product mix. They are clearly very happy with this side of the house.
Which brings us to the million-dollar question, right? If the main engine of the company is firing on all cylinders, why on earth did the stock get so hammered? Well, for one, the selling was just relentless. Take a look at the volume. On a normal day, they trade about 380,000 shares. On earnings day, almost 1.6 million shares. That's more than 4 times the average. This wasn't just a few nervous investors trimming their positions. This was a stampede for the exit.
So what were all those sellers focused on? It wasn't the strong adjusted profits management was talking about. No. The market zeroed in on the negatives, that 5.6% revenue mess, that giant write-down on the Hunter fan brand, the weak consumer trends, and all the uncertainty around tariffs. In the market's eyes, the anchor was just too heavy for the engine. Okay, so the market is clearly spooked. What's management's response? How are they planning to steer the ship through the storm? Well, they actually laid out a pretty clear playbook for us. It all comes down to capital allocation. They're generating a ton of cash. We're talking over $1 billion in free cash flow expected over 3 years. And the plan is simple. 1, plow money back into the strong business, HBP, to make it even more efficient. 2, buy back their own stock. They bought back over $40 million worth just this quarter. And 3, pay down debt, get the balance sheet even stronger.
And here's the real kicker. This is the big signal of confidence from management. Even though they had to cut their revenue forecast for the year, they did not change their profitability guidance. They're standing by that $575 to $600 million adjusted EBITDA number. What they're telling you is, we believe our strong HBP business can completely make up for the weakness in CPP. That's a bold statement. So that's the whole picture. The good, the bad, and the ugly. Which leads us to our final section, the next call. Where do we think the stock goes from here? Look, for the stock to really move higher, something fundamental has to change. The story can't just be about how great HBP is. The narrative around that struggling consumer segment, it has to improve.
So what are the things we'll be watching for? We've boiled it down to 4 potential catalysts. First, tariffs. Any kind of resolution or even just clarity there could be huge. Second, the consumer. We need to see some signs of life, some sign that people are starting to spend again. Third, we've got to keep watching the housing data. We need to make sure that HBP engine keeps humming along. And finally, we'll be watching those capital returns. Are they getting aggressive with the buybacks? That could put a real floor under the stock price.
Okay, so when you put all of that together, what's our rating? Where do we land on this?
We're calling this a market perform. Here's our thinking. That home and building product segment is so strong, it creates a pretty solid valuation floor. It's hard to see the stock falling that much further. But at the same time, with all the uncertainty hanging over the consumer side of the business, it's really tough to see any major near-term upside. The stock is kind of stuck in the middle until those headwinds clear up. So the big question going into next quarter is a simple one. Can the engine keep pulling the full weight of the anchor?
All right, that's our breakdown of Griffon's quarter. And as always, remember, this is not financial advice.